I think in the face of yesterday's sell-off, when gold was down about 1.5% in one day, the gold stocks weren't down that much. They were down 2.5%. So, I remember days that gold was down 1.5%. The gold stocks were down 6%. So I think the sentiment is turning. I think there is some buying coming in. How much longer is the Fed going to sit on the sidelines and allow this scenario to play out? I don't think much longer. I think there's a lot of pressure building now on the Fed to cut rates, and maybe not even a 25 basis point cut. Maybe we'll get a 50 basis point cut at the next meeting.
The gold market experienced a challenging week, retreating from the $2,400 per ounce level. However, it has managed to hold above a critical bullish trend line near $2,350, potentially setting the stage for renewed upward momentum. Recent economic data has shown a cooling inflation rate, with the personal consumption expenditures price index rising just 0.1% last month. The year-over-year increase stood at 2.5%, closer to the Federal Reserve's 2% target. This development and the upcoming Federal Reserve meeting could exert further downward pressure on gold prices in the short term. While some investors may view the current price dip cautiously, renowned economist and financial commentator Peter Schiff sees it as a potential opportunity. Schiff, CEO and chief global strategist of Euro-Pacific Capital, notes that gold stocks have shown resilience despite the metal's decline. This suggests improving sentiment and potential buying interest in these stocks, which are increasingly viewed as value and defensive plays. The broader market reflected the impact of gold's retreat, with the industrials group down 1.1% and the materials sector, which includes metal miners and fertilizer companies, losing 1.2%. Looking ahead, Schiff believes there is mounting pressure on the Federal Reserve to cut interest rates, possibly by as much as 50 basis points at their next meeting. He suggests the Fed may act swiftly to avoid accusations of political motivation as the election season approaches. The recent economic data has fueled expectations that Federal Reserve policymakers might use their upcoming meeting to signal a potential rate cut as early as September. Please tune in for our exploration of Peter Schiff's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
Gold had one big down day yesterday. It was down like $50 or something. It recovered about $20 today, so it finished the week down 0.5%. So not that much. That knocked the gold stocks down about 2.5%. I think in the face of yesterday's sell-off, when gold was down about 1.5% in one day, the gold stocks weren't down that much. They were down 2.5%. So, I remember days that gold was down 1.5%. The gold stocks were down 6%. So I think the sentiment is turning. I think there is some buying coming in because gold stocks are value stocks. They're defensive stocks. They should be bought. But, I noticed a lot of the stocks that I own that are defensive in our portfolio. Tobacco stocks, British American Tobacco made a 52-week high today. Consumer staples, Unilever, another stock in our portfolio. Good earnings, up, I think, about 8% in the last 2 days. Closed the week with a new 52-week high. So some of these stocks that we have in our managed accounts and our mutual funds that are defensive in nature, we're hitting new 52-week highs. That's why even though gold stocks got beaten up pretty hard this week, even as the S&P went down, because of the gains in the defensive stocks as we're getting this rotation. Now, the question is, how much longer is the Fed going to sit on the sidelines and allow this scenario to play out? I don't think much longer. I think there's a lot of pressure building now on the Fed to cut rates, and maybe not even a 25 basis point cut. Maybe we'll get a 50 basis point cut at the next meeting. Because if they don't cut at the next meeting, now you're really kind of getting closer to the election. And there may be some pressure on the Fed. Oh, you can't cut. This is just political. Of course, if they cut now, I think that's political too. But I do believe, as all Fed chairmen do, they owe their allegiance to the last guy that appointed him, which in the case of Powell is Biden. Even though Trump initially put him up as Fed chair, Biden renewed his term. And the Democrats are the incumbents. And even though Biden isn't even running for re-election. Harris is. I think he's still a team player, unfortunately, despite all the talk about Fed independence. So I think the time for Powell to do a politically opportunistic rate cut is at the very next meeting. And I think he has enough data, this phony data, that he can hide behind to try to justify the rate cut. He can say that, the inflation rates are down. They're down 2.5%, which, that's close enough. It's not quite 2%, but, we're almost there. We're on a glide path. He could see the uptick in unemployment, the increasing number of weekly claims and all the other weak data. And he could say, look, we need to get ahead of this. We need to move with a rate cut. So I think there's a very good chance we'll get that rate cut, and maybe that will change the dynamics in the market. But I think without a rate cut, if Powell keeps claiming that, we're going to be vigilant, everything is great, the economy is strong, we're going to keep rates high, I think he risks the potential of a stock market collapse.
Recent economic data suggests that the United States economy is experiencing a gradual slowdown, primarily driven by a moderation in consumer spending. As consumer expenditures account for approximately 70% of U.S. economic activity, this trend is significantly impacting overall growth rates. The effects of this moderation are evident in the GDP growth figures, which have declined from a robust 4.9% in the third quarter of 2023 to a more modest 1.4% in the first quarter of 2024. While economists surveyed by FactSet anticipate a slight rebound to around 2% growth in the second quarter, this still represents a continuation of the moderating trend. Analysts quickly point out that the observed weakness in consumer spending is not uniform across all income brackets. The impact appears to be more pronounced among low and middle-income consumers. Rather than indicating a complete halt in spending, many experts suggest that this trend reflects a shift towards more bargain-seeking behavior, as consumers become increasingly price-conscious. However, some market observers, including economist Peter Schiff, see these developments as potentially more consequential. Schiff suggests that investors may reassess the likelihood of a soft landing for the economy, a scenario where inflation is controlled without triggering a recession. Instead, he posits that market participants could be increasingly preparing for the possibility of a hard landing or outright recession. Let's get back to the interview.
At 153 3/4, that was a huge move for the Japanese yen. It took some toll on Japanese stocks. They got beat up pretty bad with a strong yen. From the perspective of a U.S. dollar investor, it was probably a push, right? The yen went up, Japanese stocks went down. So in dollar terms, there wasn't much action, but there was certainly a lot of action in Japan. But at the same time that the Japanese yen was moving up, the Swiss franc also had a pretty good gain against the euro and other currencies. And on the flip side, the weakest of the major currencies was the Australian dollar. Just got clobbered, pretty much relentless, down every day, except it gained a little bit back today. I forget what it dropped on the week, maybe 2-3%, but that's against the dollar. Much bigger drop against the Japanese yen. And I think a lot of the trading was spread trading. I think that people were unwinding some bets that they had made, maybe long the Australian dollar and short the yen. And the reason this is significant is normally when you see yen buying and Aussie dollar selling, it's because investors or traders are looking for a slower economy, because the yen is perceived as a safe haven, even though there's really not much safety in the Japanese yen at this point, but it is still a risk-off kind of currency, a funding currency and a risk-off currency. And the Aussie dollar is more of a risk on, because Australia, their main export is raw materials, iron ore, energy, stuff like that. That's the kind of goods that, you need when your economy is strong, particularly the Chinese economy. China imports a lot of raw materials that it incorporates into its manufacturing process. And so if you think there's going to be a global slowdown, there's going to be less demand for goods, raw materials to make the goods. And so you see weakness in the Australian dollar. And so we saw that in the foreign exchange markets. And I think what happened in the stock market was an effect of that it started in a foreign exchange market early in the week and then bled over into the stock market, where you saw a similar rotation out of momentum stocks, tech stocks in particular, into defensive names, value stocks. For example, the NASDAQ was down over 3% on the week. And the QQQ, which is the big cap NASDAQ stocks, was down 3.6%, so even worse. But at the same time, the Dow was actually up 0.5% on the week. The big winner on the week was the Russell 2000, which was up 3%. So 3% up in the small caps and 3% down in the NASDAQ. You rarely see a divergence like that. The overall S&P down 1.5% on the week. And these numbers would have been worse if we didn't get a rally today. But to me, I think what's happening here is investors are starting to price out the soft landing hypothesis, and they're bracing for a hard landing. And a hard landing meaning a recession. Now, of course, I think we're in a recession. Certainly manufacturing has been in a recession pretty much for the entirety of the Biden presidency, which is why it makes me so mad every time I hear Joe Biden talk, to the extent that he can talk. And he talks about the booming economy, how great manufacturing is. Of course, Trump said the same thing, and it wasn't true when Trump said it, and it's not true when Biden says it, but manufacturing has been terrible.
Considering the recent economic data indicating a slowdown in consumer spending and the significant impact this has had on GDP growth rates, what are your thoughts on the future trajectory of the U.S. economy? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.